Hey guys, in this video I want to talk about reducing my position in the long US Swiss franc and transferring that risk into the long gold against the Hong Kong dollar position. So first of all, the rationale behind closing part of this position is that it's already broken past the support there. So the price has already broken past that support, and there is a pretty bearish candle previous trading day, and overall bearish price action. So I think that's really, if you look at that, we were in a downtrend previously, and then it looked like maybe something may have changed, and that we would see a change of trend and you'd go back into a long uptrend. However, you can tell that was not the case, as that trend has now been broken. So initially downtrend looked like we might be seeing some sort of bullish bounce back. However, you can see the doji equilibrium there, and then suddenly so much bearish price action that kind of indicates that the thesis of this big bullish bounce back up has kind of not proven to be true. So definitely at this stage not confident about a bullish bounce in this US dollar Swiss franc position. So just reducing it to reduce risk. If we look at the US dollar against other markets, you can see that there is a bit of bearish action there, bearish price action past couple of days as well. Against the Australian dollar, once again you can see that the US dollar is weakened. Another look at the pound. Once again the US dollar has weakened. Euro, once again the US dollar has weakened. So I mean in this particular chart where the US dollar is the second part of the pair, an upwards movement in the chart actually signifies weakness in the US dollar. We can even have a look at the New Zealand dollar. Same thing, we're just seeing weakness against most currencies in general, weakness in the US dollar. So technically not looking good. Intermarket wise, weak against multiple currencies. Have a look at gold. It's a little bit of weakness, but not really too evident at this stage. So essentially the result is that I'm going to lose a little bit of money exiting this trade, probably a little bit late. I think having seen it go to support with that kind of a big bearish candle probably was an indicator that I should have gotten out on that particular trading day. Psychologically I feel fairly neutral, although there was a little bit of regret that I got out late, but also not too fussed about it due to the fact that I would like to take the risk off of this trade and put it into the long gold against the Hong Kong dollar position, which kind of makes it feel like it's not a total loss. So really the lesson is I should have exited this trade a little earlier. Now the second part of this video I want to talk about increasing my long gold against the Hong Kong dollar position. So I'm thinking of transferring the risk into this position because, you know, if you look at this chart, we're at that point where it looks like it could potentially break up again. the rationale for having a long gold position stays the same. It does look like we're getting a little bit of a bounce back up. So that could be interesting. Here, if you have a look at that, and it looks like we've failed the initial break upwards. This is a 4-hour chart. We've seen an exaggerated sell-off, and then we've seen it recover from that, and the price has come back down again, and it's just kind of gone nowhere for a bit with another push of buying pressure. It's come back down. It hasn't come back down as far as it previously has, indicating there's a bit of buying that's going on under the scenes, behind the curtains, and I think potentially we can see that bullish price action force this price back up, and that would really signal to the breakout traders to enter the trade. As you can see, it's been stuck at that level. If it breaks above that, it certainly can break higher. Looking from a very long-term perspective, 2013, you can see it's been in this kind of trading range. It's broken higher than it has been for a couple years now, and going to the monthly, it's certainly looking like it could just rocket higher. That's the main gist of why I'd like to transfer the risk to this trade. The US dollar does seem to be fairly weak recently, so that kind of indicates that it's something that will help this trade. That's potentially due to the fact that there is discussion about rate cuts, the Fed and whatnot, and that's kind of shown in the fact that we're also seeing the S&P 500 go to all-time highs, which does seem to be some sort of result of the potential weakening in monetary policy. So those are the trades I want to talk about today in this video. So entering at around this price with a stop loss at that price, looking to go to a profit target of around, at least around here. But if the price action does look good, I think I'll continue to hold the trade until the price action no longer looks good, and just ride, hopefully, a winner. If it does kind of go sideways or drops, then potentially I may get out, although I like this kind of tightening, winding up price action here. That actually kind of indicates to me that I should be accumulating my position rather than getting out too quickly. So that's all for this video. Well, one more thing I want to add is just psychologically, I do feel a little bit more confident because I see this kind of winding up in the position. That makes me feel fairly confident that we're going to see a break higher. Warranted or not warranted, we'll see. So that's it for this video. Thank you for listening.